Chapter 4, Contrarian Investing, the Psychology of Going Against the Crowd. In this chapter, Mr. Parikh discusses about 1. What is contrarian investing? 2. Why is contrarian investing difficult to follow? 3. Empirical study, conventional versus contrarian portfolio. 4. Case study, VST Industries, a blossom in the desert. Section 4.1, What is contrarian investing? Contrarian investing involves going against conventional wisdom in the financial markets. It's not about believing that conventional wisdom is always wrong but about profiting when the consensus opinion appears to be incorrect. Differentiation of contrarian investors lies in their emphasis on finding opportunities where consensual opinion has led to mispricing of the asset. Contrarian investors exploit situations where consensual opinion exaggerates problems, often due to mass psychology. This approach stems from the belief that sometimes even efficient markets can be inefficient, driven by factors like fear and greed, hence, providing the contrarian value investor to generate above-average returns and beat the markets. Section 4.2, Why is contrarian investing difficult to follow? In this section, Mr. Parikh discusses about why contrarian investing is difficult to follow. Sound investment involves the goal of buying low and selling high. The foundation that is the basis for making those buy and sell decisions can be divided into two types: A. Fundamental analysis, B. Technical analysis. A fundamental analyst will compare current price with historic and prospective earnings. The fundamental approach can be further subdivided into top-down approach, a bottom-up approach, growth, value, country-specific, and commodity. On the other hand, the technical analyst will compare current price and volume patterns to the price and volume patterns from the past, along with many other indicators pertaining to supply and demand for shares of a specific company. Among the fundamental analysts who constitute a majority of the investment community, what is it that differentiates contrarian and value investors from the rest? And why is it that people who subscribe to this school of thought only constitute a minority, despite no major distinction in their basic foundation? Possible answers to these questions can be found in the form of two types of constraints: psychological and organizational. Section 4.2.1, Psychological constraints which make contrarian investing difficult to follow. Investors often use heuristics to simplify decision-making but may harm their investment performance. Psychological heuristics making contrarian investing difficult are: A. Group thinking. This is the fear of going against group consensus, prevalent in institutional settings. Most people tend to go with the group as if they are wrong. They have the comfort of having an entire crowd which is also wrong along with them, but this kind of thinking seldom brings good results in investing. B. False consensus effect. This is about overestimating the percentage of people who would agree with you. As an investor, the decision we reach about an investment opportunity does not necessarily have to be in accordance with most other people. Their motives for investing in the stock market might be different, their philosophy, their risk appetite and their expectation from business might be different from ours. C. Buyer's remorse. This is the self-doubt most people face after committing capital to an investment. They start feeling as if they have made a mistake and may lose it all and are tempted to reverse their decision. D. Ambiguity effect. This is about seeking social proof or authority in the face of uncertainty. Investing involves facing uncertainty in the form of changes in price movements and unexpected performance from the underlying businesses. In short, it can be said that while investing, one is faced with lots of uncertainty coming from all corners. This effect can range from ignoring cheap stocks from out-of-favor sectors to buying into speculative stocks based on widespread acknowledgement through media and experts to justify one's stand. E. Illusion of control. Investors forget that chance plays a critical role in governing the exact outcome of our endeavors. Our job is to ensure that good work will eventually be rewarded in the long run. The same applies to stock market investing. F. Herding. As an investor, it is difficult to think out of the box or to stand outside the pack for consistently longer periods of time. It is difficult to maintain contrarian views amid social pressures. G. Myopic loss aversion. Warren Buffett said that, if you cannot stand 50% paper loss on your stock, stay away from the markets. Loss aversion refers to the fact that people are more upset when they experience losses as compared to the satisfaction they derive from a similar gain. This tendency leads to a behavior wherein investors, faced with the prospect of temporary quotation loss, tend to forego investing in such situations even if, in the long run, such an approach leads to higher returns. Recency effect. This happens when investors tend to rely on recent data and forget about the long term, considering historical context. To be a contrarian investor, one needs to have the ability to place the present situation in the context of not only the present or the recent past, but also to go far into the past and put things in perspective. Confirmation trap. There is generally a lag between an action and its desired outcome. And there is never a surety that a particular action will lead to a particular outcome. Under such circumstances, it is only natural to validate one's stance by seeking confirmation from the actions of other people. But as a contrarian investor, one has to learn to stick to and to test one's own views and stance, and this makes contrarian investing difficult to successfully implement. Section 4.2.2 Organizational constraints which make contrarian investing difficult to follow. A significant portion of capital goes to institutional investors, mutual funds, etc. There are conflicts of interest between institutions and unit holders and asset managers. Investment as a business or profession, institutions often prioritize attracting more capital over performance as they are compensated as a percentage of assets under management and not on their performance. Looking right versus being right. Asset manager employees favor appearing right within their organizations to safeguard their jobs and careers, thereby hindering contrarian investing. Decision-makers within institutions may prioritize job security and reputation over contrarian bets. At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel. Section 4.3 Empirical Study, Conventional versus Contrarian Portfolio. This section, Mr. Parikh discusses a study his organization conducted on the Sensex. The BSE Sensex, composed of 30 leading companies, reflects the performance of the Indian economy. Investors face the choice of buying stocks in sectors with optimistic prospects or those with pessimistic outlooks when aiming to profit. The study seeks to challenge the conventional wisdom that investing in high-performing, high PE stocks is the best approach for superior performance. This study aims to examine whether companies with high PE ratios and positive outlooks outperform low PE stocks with pessimistic outlooks over a decade, or was it the other way round? Section 4.3.1 Methodology. The study examines two portfolios based on PE ratios, that is, conventional portfolio with high PE stocks versus contrarian portfolio with low PE stocks. A. Conventional portfolio. Invest in the 10 highest PE stocks from the Sensex each year and repeat the process for a decade. B. Contrarian portfolio. Invest in the 10 lowest PE stocks from the Sensex each year and repeat the process for a decade. C. The results of this study aim to provide insights for prudent investment strategies. Section 4.3.2 Conventional portfolio. Conventional portfolio consists of high PE stocks based on the majority's positive outlook on the industry and its representative stocks. The portfolio's average PE ratios have varied from a low of 20 in 2003 to a high of 79 in 2000. The average PE ratio across 11 such portfolios constructed between 1995 and 2005 is 40 times trailing 12 months earnings. Section 4.3.3 Contrarian portfolio. Contrarian portfolio consists of low PE stocks due to the majority's belief in unattractive prospects for the industry. The portfolio's average PE ratios have ranged from a low of 11 in 2000, 2002, and 2003 to a high of 18 in 1996. The average PE ratio across 11 such portfolios is 14 times the recent 12 months earnings. Section 4.3.4 Results. The study's results show that the contrarian portfolio outperformed the conventional portfolio over the entire 11-year period. The contrarian portfolio exhibited steadier growth with much lesser volatility risk compared to the conventional portfolio, which consisted of high PE stocks. During the IT bubble, the conventional portfolio performed well, but the contrarian portfolio gained more in the subsequent years. Section 4.3.5, Important Lessons. The conventional portfolio outperformed in only 3 years out of 11. The contrarian investing can lead to better results, especially during bear markets. The risk-reward ratio is crucial, and the contrarian portfolio had lower risk due to exposure to laggard stocks. Contrarian investing can yield superior long-term results. Section 4.4, Case Study, VST Industries, A Blossom in the Desert. In the last section of this book, Mr. Parikh discusses about VST Industries and how the stock was an ideal pick for a contrarian investor. In brief nutshell, his study says that VST Industries belonged to the tobacco industry, which faced regulatory challenges due to the health risks associated with tobacco products. The company enjoyed a unique position with minimal competition and high barriers to entry. The balance sheet of VST Industries showed financial stability, strong cash flows, and VST was a zero-debt company with excess cash. Through a conservative discounted cash flow estimate, assuming no growth in cash flows over next 10 years, the intrinsic value estimate suggests that VST Industries was available at around 50% of its conservatively calculated intrinsic value. A reasonable intrinsic value estimate, considering a 5% growth rate, also indicates that VST Industries was even more significantly undervalued. Further, the dividend yield on the stock was over 6% at the time of the study, meaning that the contrarian investor in VST Industries was getting paid a handsome annual dividend for waiting for the stock market to discover the mispricing in VST Industries and hence greatly benefit from his sound contrarian bet through capital appreciation and dividends over the long run. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you. Stay tuned for next chapter.